Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of the corporate world. Today, we're diving into the latest 10K filing from Personalis, a company with a name that sounds like it should be selling personalized stationery, but it's actually in the much more complex and fascinating world of cancer genomics. You might think reading about genomics and financials is about as exciting as watching paint dry, but trust me, there are some juicy details in this report that tell a real story about where this company is headed. This 10K, which is like the company's annual report card, gives us a look at Personalis' performance for the past year. The big headline, they're still losing money, but they're making progress. The company develops and sells genomic tests focusing on personalizing cancer treatment. They work with big pharmaceutical companies, diagnostic firms, and even have their own clinical tests for cancer patients. It's a competitive field, so let's see how they're holding up. First, the usual disclaimer. This report contains forward-looking statements, meaning they're making educated guesses about the future, and actual results could be different, maybe even dramatically so. Keep that in mind as we go through this. They talk about everything from cancer therapies evolving to their ability to obtain financing. One of the first things that jumps out is the long list of risk factors. It's like Personalis is bracing for a storm on all fronts. From the intense competition, customer concentration, and to potential regulatory crackdowns, they sure aren't pulling any punches with acknowledging the realities of their business. The most basic risk, they have a history of losses and expect to keep losing money. They might not even make enough money to stay afloat. This is a recurring theme, it seems. For the year, they had a net loss of $81 million. As of the end of the year, their total deficit had ballooned to over $500 million. This is definitely something to keep an eye on. They need to turn things around, or that personalized stationery might be a more viable business after all. Another major risk is their reliance on a few key customers. Currently, a large chunk of their revenue comes from just two companies, Natera and Moderna. If either of those relationships sours, Personalis could be in trouble. They also have some risk coming from the U.S. Department of Veterans Affairs Million Veteran Program. If those contracts are terminated, their business will really suffer. To counter those concentration issues, they're trying a partner-centric strategy, cozying up to names like Tempus, Myriad Genetics, Moderna, and Merck. But these collaborations could go south too, either by not performing or by ending before they expected. Of course, being in the medical field means navigating a regulatory minefield. They acknowledge that their tests might face regulatory action if they don't comply with FDA or CLIA requirements. If that happens, it could shut down their testing services, disrupt their business, and make them subject to judicial or administrative processes. And in this day and age, you can't forget about cybersecurity. They admit that their IT systems or those of their vendors could get hacked, leading to data breaches and other disruptions. That could hurt their reputation, cause them to lose revenue, and expose them to legal battles. On the topic of legal matters, Personalis highlights that it is susceptible to litigation and third-party claims of intellectual property infringement, and that it is expensive and could prevent them from selling their tests. The company also admits that if it cannot license rights to use necessary technology, it may not be able to sell its tests. The risks don't stop there. There's a whole section that talks about market risks, financial risks, and ownership risks. One that stands out is the threat of legal action from competitors based on statements the company makes. Okay, enough doom and gloom. Let's get to the financials. Looking at their financials, they manage their business as one operating segment, providing advanced cancer genomic tests and services. For the year, their revenue increased 15% to $84.6 million, primarily driven by higher revenue from pharma tests. It's not much, but it's progress, especially in these tough times. As for expenses, well, they're still spending a lot more than they're bringing in. Research and development is a big drain, as is the cost of running their operations. They are also affected by changes in healthcare policy. The company had 229 employees as of January 31, 2025. They mention their dedication to diversity by broadening their reach for potential candidates. The aggregate market value of the company was approximately $71.6 million. There were roughly 88 million outstanding shares. Investors are warned to not expect any dividends on the company's common stock. They derive a large portion of their revenue from the VA MVP program, which, depending on funding, can fluctuate the total revenue of the company. Diving into management's discussion, the big picture is that Personalis faces stiff competition, relies heavily on a few key customers, and needs to manage its growth carefully to avoid getting overwhelmed. They need to keep innovating and proving the value of their services to both pharmaceutical companies and individual cancer patients. The FDA is also making regulatory changes that could affect their tests, which require costly post-market surveillance. Regarding ethics, the company said they have a code of conduct for all directors, officers, and employees, but it is not always possible to identify and deter employee misconduct. The company mentions past and potential future internal restructuring activities that could result in disruptions. The company also details in the filing the cybersecurity risks and how they deal with it. The filing states that the company is vulnerable and that such claims could negatively impact their ability to commercialize tests. Even more concerning, the data that is being managed may not be in compliance with regulations. There is also a risk that their stock will decline if analysts don't cover the company or unfavorable research is published about it. There are some limitations on the value of the stock. Now, what does all of this mean? From my perspective, the company has some serious hurdles to overcome. That customer concentration is a major red flag, and the risk factors section points to potential difficulties ahead. The path to profitability looks long and winding, and they're operating in a competitive market. I am, however, optimistic for the recent Merck partnerships to have great results. All in all, it is a risky play. But if they can successfully navigate those challenges and start generating consistent profits, there might be a pot of gold at the end of the rainbow. That's all for this episode of Corporate Decoder. If you found this breakdown helpful, be sure to hit that like button, leave a comment below, and subscribe for more deep dives into the world of corporate filings. Thanks for watching.